Today, we're talking about what derivatives are and the different types of derivatives that exist. My name's Sean, and here on the channel, I explain different financial products, helpful strategy, and insights that the financial world has to offer. Today, we'll be discussing an asset class that is often highly controversial in the media, especially in times of crises, and is rarely understood by retail investors. The term derivative comes from Latin and means nothing more than to derive or originate from. This already gives a good explanation of what a derivative is. It is a financial product derived from another financial product, the so-called underlying asset. This underlying asset can be other securities such as stocks or bonds, but can also be more abstract indicators like indices, interest rates, or price movements. Derivatives have no intrinsic value. They originate from another financial product and benefit from its rise or fall in value. Derivative is an umbrella term for a vast universe of financial products. There are now over 1 million derivatives that exist. That includes products like convertible bonds, options, CFDs, swaps, or futures. Most derivatives are traded OTC, meaning over the counter, which refers to transactions conducted directly between parties outside of formal exchanges. However, many derivatives can also be traded on exchanges. Some derivatives even have their own dedicated exchanges, like the Eurex for futures and options. Derivatives are used for both hedging and speculation purposes. So, are they a curse or a blessing for the economy? Let's put that question aside for now and first take a look at how derivatives actually work. Let's assume you've purchased a derivative based on the oil price. You are a driver and have always been annoyed by the rising gas prices. Now you want to benefit from the rising oil prices. Let's say Brent crude oil, the standard unit for oil on the stock market, is currently priced at $100. You've bought your derivative for $10 and it tracks the Brent oil price 1-to-1. If the oil price now rises from $100 to $110, your derivative also increases from $10 to $11, which corresponds to exactly 10%. If you want to benefit even more from the price movement, you could purchase a derivative that tracks the oil price at a ratio of not 1-to-1, but 1-to-10. In this case, your derivative increases 10 times faster than the underlying price. So, your derivative would then be worth $20 instead of $11. However, you also take on greater risk, as you could also lose value more quickly. As you can see, with derivatives, you can essentially bet on price movements without having to own the underlying asset itself. In this case, Brent crude oil. You are betting on a rising oil price, while someone else is hoping that the oil price will fall and is betting against you. Instead of betting, derivatives can also be used for managing and protecting against risk. This is called hedging. Let's take the example of a wheat farmer who wants to protect himself against the risk of price fluctuations in wheat. He wants to do this before his harvest, let's say 9 months in advance. He wants to know today that in 9 months he will be able to sell a ton of wheat for, let's say, $200. In this case, he can buy a derivative, such as a future, which guarantees him the right to sell for $200 in 9 months. His counterparty could be, for example, a cookie factory that also wants to hedge against price fluctuations. In this case, hedge against the rise in the price of wheat. Both parties now have price certainty 9 months before the sale, and this price will not change anymore. If the wheat price falls on the stock market, the farmer will have made a good deal. Let's assume the wheat price on the stock market is now $140. He can sell for $60 more because he locked in the contract at $200. However, if the wheat price rises to $230, the cookie factory will have made a good deal because it can buy for $200 instead of $230 per ton. Many companies engage in these hedging transactions, especially in sectors like commodities and currency hedging, where this is very common. At the beginning, I mentioned that the term derivative is an umbrella term for a whole universe of financial products. So let's take a look at how we can categorize derivatives into different parts. There are unconditional derivatives and conditional derivatives. In both examples we just explained, the oil price and the wheat price, we had unconditional derivatives. These derivatives are executed without conditions. The wheat farmer must sell at $200 per ton, and the cookie factory must buy at $200 per ton. Unconditional derivatives include futures, forwards, and swaps. Our example with the wheat farmer would be different if he had chosen a conditional derivative. Let's take the example of an option. He could have bought an option that gives him the right to sell at $200, but not the obligation. If the market price is below $200 per ton, say $100, he would exercise the option and sell for $200. However, if the market price is above $200, let's say $300, he would let the option expire and sell for $300 on the open market instead of fulfilling the option contract. To have this option, which grants the right but not the obligation, he would have to pay what's known as an option premium. This is very different, of course, to your right but not obligation to like this video and subscribe to the channel. Please help. Please help. Please help me. Please help me. I can imagine this all sounds quite complicated, but that's not surprising, as derivatives are among the most complex instruments the financial world has to offer, so don't let it confuse you. Now that we know how derivatives work and the different forms they take, we need to return to the question of whether derivatives are merely bad speculative tools or if they can actually be beneficial for the economy. In my opinion, derivatives can be compared to a knife. If you have a knife in your kitchen to cut vegetables or use it to eat, it's very helpful. However, a knife can also be used as a weapon. The same applies to derivatives. On the other hand, the global derivatives market has now ballooned to the range of $600 trillion to over $1 quadrillion. Some analysts even place it roughly 10 times the GDP of the entire world. So there are far more hedging transactions or bets being made than actual underlying trades. This is a clear indicator that there are many more speculators in the market than people who are actually looking to hedge their risks. But speculators in themselves are not a bad thing, as they provide liquidity to the market and help businesses transfer risk. But things look different when bubbles form and prices are artificially inflated. In the past, some banks have been accused of speculating on food prices, such as corn or wheat, which then caused prices to rise to the point where people in developing countries could no longer afford these commodities, leading to widespread hunger and famine. That's it for the topic of derivatives. If you have any questions or thoughts, post them in the comments. And if you enjoyed this video, then you might want to check out this video over here, which is about bonds, which I've also linked in the description below. Thanks so much for watching, have a great day, and I'll see you in the next video.